not Hongzhong. That could be a new territory in PRC, but it should be Hong Kong. Bulgaria is one of them. Brunei is too small even to mention. You guys even know where Brunei is? Or Brunei? What do they teach you in high school geography? Just the state capitals, that's it? You guys should learn about... Have you heard of an island called Borneo? It's probably third or fourth largest island in the world. Most of it belongs to Indonesia. Some of it belongs to Malaysia. But there's a little corner at the top middle that's an independent sultanate. Okay, the Sultan of Brunei is famous for his extensive harem. He actually takes a lot of models from the international market to his harem. The guy has money. Why? Because they got oil there. So Brunei is another one. So they use US dollars. They use a currency board. There's a so-called conventional peg. They do use a fixed exchange rate, but it is not necessarily backed by any reserve asset. And Jordan, Saudi Arabia, and Morocco are among them. Of course, in the case of Saudi Arabia, they want to do that. What's one thing we know Saudi Arabia has? They have oil. I mean, they buy a lot of luxury stuff from abroad, but they have consistent trade surpluses or current account surpluses. When you have that kind of surplus, normally if you have a flexible exchange rate, your currency wants to increase its value. But they don't want that. Okay? They don't want their currency to increase in value. Hence, they have a peg. If somebody actually wants to buy more reals, that's the Saudi Arabian currency. And the little 3 letters for that is SAR. That's why South African Rand is ZAR, as we talked about it in the beginning. They have so much reserves. Anybody who wants to buy Saudi Arabian Rial in the open market, they say, okay, I'll sell it to you at that rate. They have almost infinite reserves. So if you say, I'm going to buy a lot of Rial with the hope that it's going to increase in value so that I can sell it later, well, those guys have, they have, even though it's irrational for them, maybe, they have so much reserves, they're going to keep supporting you until you're no longer solvent. You cannot fund that position anymore. So nobody not attacks in that mean, Saudi Arabian Rial. Morocco doesn't have that kind of stuff, but they also have a conventional peg. This so-called stabilized arrangement, you arrange that your currency is going to remain within a well-defined band around the central peg. Indonesia, Singapore, and Lebanon are among them. And typically it's a 2% band, but it could vary. Back in 90s, late 80s, early 90s, which we're going to talk about a little bit later, there was a system called, this was before Euro, European Exchange Rate Mechanism, ERM. For example, Britain fixed its exchange rate with German Deutschmarks. That would be German marks, just Deutschmarks. But they allowed variation within plus or minus 1%. You guys may have heard of a little known Hungarian-born guy, George Soros, right? Do you know how he became George Soros? yes, he was born George Soros, but he actually became the hedge fund manager, big hedge fund manager, because he realized back in early 90s, United Kingdom had pretty large trade deficits, but within the exchange rate mechanism, European exchange rate mechanisms, they were not allowed to devalue. That meant there's a common theme, one thing that all economists agree on one thing. Economists always disagree about a lot of stuff, but there is one thing they all agree on. In any exchange rate regime, you can either keep an exchange rate fixed or an interest rate fixed, but you can't do both. If your currency needs to be devalued, but it's not, that means you are having monetary contraction effectively. So interest rates have to go up. What happens when interest rates go up? Overall economic activity goes down, right? That's what Fed is trying to do, to cool down the economy so that inflation comes down. We're still growing around 2%, but at some point we're going to do negative or relatively low positive numbers. So it's kind of a cycle that feeds on itself. You have trade deficits, your exchange rate remains fixed, that increases interest rates, which further decreases your GDP, which further increases your trade deficit. It's kind of a cycle. Soros saw that this was pretty much untenable. So he started attacking British pound in the futures market. One thing about futures markets, which we're going to start talking about it after Labor Day break, you can control a large position with very little money. Example, let's see, CME Euro futures. Or specs, actually. Each contract is 125,000 euro. So you can have a long position, which means you benefit from increases in price. A short position, you benefit from decreases in price. And all the collateral that you have to put in is $2,400. You know, at the current prices, 125,000 euro is about 145,000 US dollars. So you're controlling your position of size, let's round it up to 150,000 by putting down at most 3,000, okay? So that's 50 times leverage. So if you want to short British pound, 2 billion pounds, they had similar margins those days. All you had to do is 2% of that is 40 million pounds. Even hedge funds of early 90s could easily come up with that kind of money. So he attacked, and at some point it became untenable because the interest rates had to go up so much, it was hurting everybody in United Kingdom. It's being a democracy, they have elections. So they said, okay, we're gonna devalue the pound. Guess what happened when pound was devalued? Soros was shorting pound, so he made a lot of money. I think he made about 1 billion sterling. And those days, 1 pound bought more than $2. And 1 billion was really 1 billion in 1990s. I mean, if you had a $2 billion position in a major American investment bank, and you were running let's say, the prop desk, they probably would have fired you because that would have been way over your trading limit. Now junior traders have that kind of trading limits. So $1 billion or 1 billion pounds was real money those days. You know, the Barclays Bank, which was known as the Queen's Bank at the time, went down because they lost 1 billion pounds in the futures markets. For a lot of different, there was a rogue trader. There's also a movie about it. I think Nick Leeson was the name of that guy. Look up the movie, it's an interesting one. And nowadays, you know, JP Morgan loses $1 billion, nothing will happen to JP Morgan. Barclays was the JP Morgan of United Kingdom. Think of it that way. They were the largest bank. They ended up being sold to ING Barings for $1, which was a Dutch bank. You have the so-called crawling peg. It basically, you have a peg, but that peg moves according to a certain formula. For example, Turkey had something like that, which was technically a crawl-like arrangement. Implicitly, the central bank allowed the currency to devalue every month by the amount of expected inflation. So that meant in real terms or inflation-adjusted terms, they were trying to keep the value of the currency fixed. That's kind of what crawling pegs or crawl-like arrangements are. And you have, you know, with horizontal bands, you know, same idea. Of course, we're not going to worry about Tonga too much. Who knows where Tonga is? It's a little atoll island. It's basically a volcanic island in the Pacific Ocean. And more than likely, that island is not going to exist after 50 years. Because, you know, with the melting of the glaciers, the sea levels are going to rise up, and that country will cease to exist. You know what's their biggest product?